Okay, students, another MTQ. The following scenario relates to question 21 to 25. Meridian Company has a year end of 31st December. Remember, the year end for the Meridian Company is 31st December, so the year start will be 1st January. The following transaction related to the year ended 31st December 20x4. So the current year end is 31st December 20x4, so the year start will be 1st January 20x4. Let's talk about the lease number 1. On 1st January 20x4, Meridian Company commenced a 4-year lease to acquire the use of specialized production equipment. Okay, so Meridian Company entered into a lease agreement on 1st January 20x4, means at the start of the year, the lease terms are 4 years and they acquired a specialized production equipment. Lease payment are $50,000 per year payable in arrears, not in advance, but the payment will be done in arrears. With the first payment on 31st December 20x4. The interest rate implicit within the lease is 6%. To secure the lease, Meridian Company incurred $2,000 of the legal fee. $2,000 of the legal fee. For what? To secure the lease. For secure this lease, Meridian Company incurred $2,000 of the legal cost. So legal cost is a compulsory cost. It is because of this lease. So it will be capitalized, right? It will be capitalized. Meridian Company is obliged to dismantle the production equipment at the end of the lease terms, right? They have to do the dismantling as well. At 1st January 20x4, Meridian Company estimated that the present value of dismantling cost was $3,500, and it will also be capitalized because it's a compulsory cost. It will be capitalized. Dismantling cost $3,500, and recognize this amount as a provision. The present value of the lease payment discounted at 6% is $173,255. It is the present value. So on this amount, Meridian Company will recognize finance lease obligation, and for right of use asset, let me give a heading. Lease number 1. Okay, so for the lease number 1, the value for finance lease obligation, it will be credited by 173,255. And for right of use asset, we have to calculate it, right? It will include the present value of the lease payments, means the finance lease obligation. We have to capitalize the legal cost, which is $2,000, and we have to capitalize the dismantling cost as well, which is $3,500. 173,255 plus 2,000 plus 3,500. So it is equal to 178,755. So it will be the initial value for right of use asset, 178,755. Right? And this asset will be depreciated over the lease term, which is 4 years. So the depreciation expense, if I calculate it, the depreciation expense will be 178,755 divided by 4, which is equal to 446,888.75. If the examiner asks the carrying value, so it will be cost minus depreciation, and you will get the carrying value, which is equal to 1,340,66.25. So it will be the carrying value at the end of the year, and it will be depreciation expense for the year, right? Now, if I make a lease amortization schedule for finance lease obligation, so let me prepare the table as well for that, which includes the debt, opening balance, interest expense because the payment is in arrears, right? Then the interest payment in the closing value. So the date will be 31st December. The year end is 20x4. The opening balance will be this, which is 173,255. The interest expense will be calculated at the rate of 6%, right? It is the rate of interest. So 173,255 multiplied by 6%, which is equal to 10395. Then the interest payment is annually in arrears, which is 50,000. And the closing balance will be 173,255 plus 10395 minus 50,000. So it's equal to 133,650. Clear? So it is the total liability. Now we have to split this total liability into the current liability and non-current liability. So for that, I already told you in my lectures that if the examiner asks current liability or non-current liability for the year ended December X4, so you have to prepare the amortization schedule for X5 as well. If the examiner asks for X6, you have to prepare it for the X7 to split the total liability into the current liability and as well as into non-current liability, right? So I have to prepare this table for the next year as well. This value will become the opening balance for the next year. Then the interest expense will be at the rate of 6%, which is equal to 8019. Annual payment is same, which is 50,000. And the closing balance will be 91,669. So it will be considered as a non-current liability, and the difference between these two will be current liability, which is equal to 41,981. 41,981. So it was all about the lease number one. If the requirement of the examiner is to calculate the depreciation expense, it will be this, right? And I will round it according to the requirement of the examiner, right? If they want to answer up to 2 decimal places, so this will be the answer. If they want it up to the 1 decimal place, then I will round it. If the examiner asks to the nearest dollars, means to remove the decimal place, then I will round it as well according to the requirement, right? If the examiner asks the carrying value, it is this. If the examiner asks the interest expense for the year ended 31st December 20x4, it will be 10395. If the examiner asks the current liability, it is 41981. And if the examiner asks non-current liability for the lease one, it will be 91,669. So it was all about lease number one. Okay. Now let's move to lease number two. Lease number two. Okay. On 1st July 20x4, 1st July 20x4, mid of the year, right? 1st July 20x4, mid of the year. Meridian Company decided to acquire tablet computers for its sales staff. 10 tablets were acquired on a 2-year lease. The initial payment of 3,000 was made on 1st July 20x4. 2 annual lease payment of 6,000 were due to be paid on 31st December 20x4 and 31st December 20x5. Meridian Company correctly decided to use the recognition exemption permitted by IFRS 16 leases. Now, if the examiner told you in any question of IFRS 16 leases that they are correctly decided to recognize exemption permitted by IFRS 16 leases, so it means the examiner is telling you to follow the operating lease for that lease, right? Means you have to ignore the finance lease. You have to follow the operating lease, means the rules of operating lease. When the wording is just like this, that exemption permitted by IFRS 16 means you have to follow the rules of operating lease, not finance lease, right? So if I calculate the total cost for this is 3,000, which is already paid, 3,000 is paid. And the Meridian Company will do further 2 payments. They will do further 2 payments. They only paid 3,000, but they will do further payments of 6,000, two payments, right? So the total amount for this will be 3,000 plus 6,000 plus 6,000 is equal to 15,000. Right? It is for the 2-year lease. Now we have to follow the rules of operating lease. So we have to calculate the expense just for the current year end. So 15,000 divided by 2. And in the current year, it will be only for the 6 months. 15,000 is for the 2 years. And current year, we will only use it just for the 6 months. So 15,000 divided by 2, multiply 6 by 12. So expense for the lease number 2 will be 3750 for the year ended 31st December 20X4. Okay, now the last, which is the sale and leaseback transaction. Meridian Company sold an item of plant on 1st October 20X4 to a finance company and immediately leased it back for a period of 5 years. The plant is immediately leased back for the 5 year, which is the remaining useful life of the plant. Now, what should we do? What should we do? Should we recognize the sale or the performance obligation are satisfied? The total useful life of the plant is 5 years. I sell it and lease it back for the 5 years. Did I transfer the control? The answer is no. I didn't transfer any control. So if no control is transferred, it means that no sale will be recognized. You will not recognize the asset, and any amount received will be treated as a loan because no control is transferred. The total life of the plant is 5 years. I sell it and lease it back for the 5 years, right? So it means that no control is transferred. No control is transferred. So if no control is transferred, no gain or loss should be calculated. Meridian Company should not de-recognize the plant, right? And any amount received by the Meridian Company will be treated as a loan, and they will recognize interest expense on that amount, right? The fair value of the plant at the end of the lease period is estimated to be nil. So this was all about the background information, of an MTQ named as Meridian Company, which cover IFRS 16 leases, right? Okay. Now, let's move toward the requirements. Requirement number 1. What is the initial measurement of the right of use asset on 1st January 20X4? So the initial measurement for the right of use asset is 178,755. So the correct answer is 178,755. Sorry. Okay. So the correct option is C, 178,755. Requirement number 2. What is the carrying amount of the non-current lease liability in respect of the lease 1 on 31st December 20X4 rounded to the nearest dollar? So non-current liability already calculated 91,669 for the year ended 31st December 20X4. 91,669. Okay. Requirement number 3. Match the correct amount to be recognized in the financial statement of Meridian Company in respect of lease 2 for 20X4 for the lease 2. So what is the requirement? We have to calculate the expense to be recognized in the statement of profit or loss and the current liability in the statement of financial position. So for the year 2, I already calculated the expense, which is 3750, because the total amount for the lease 2 is 15,000, and we have to follow the rules of operating lease, not finance lease, because examiner clearly stated that they correctly decide to use the recognition exemption permitted by IFRS 16. So we have to follow the rules of operating lease. So the total cost is 15,000. It will be divided by 2 because the lease term is 2 years. It is written here, it is for the 2 years, right? And currently we will only use it for the 6 months. So multiply 6 by 12, the total expense is 3750. Now we have to calculate the current liability as well. So as if you look to this para for the lease 2, only one payment is made, which is 3,000. Only one payment is made, which is 3,000. The next 2 payments were due. They are not paid yet. They were due. to be paid on 31st December 2004 and X5, but not yet paid. The only payment which Meridian Company made is of $3,000. So if the expense, if I make the double entry, right? If the expense is debited by 3750 and only payment made by the Meridian Company is 3,000, so the balancing figure will be recognized as a liability, means it is payable, which is $750. The total expense recognized is 3750. The payment made by the Meridian Company is 3,000. So the rest of the balance will be considered as a current liability, which is $750, right? So 3750 will be considered as an expense. It will be expense, right? And it will be the current liability. It is for this, and this will be for this. Okay. Next requirement. In respect of the sale and leaseback transaction, identify whether each statement is correct or incorrect. Recognize the sale proceed as a loan liability. Yes, as I already told you, that it will, the control is not transferred. So if the control is not transferred, any amount received will be considered as a loan, right? Because the total useful life of the plant is 5 years. Meridian Company sell it and lease it back for the 5 years. So no control is transferred. If no control is transferred, they will not recognize any gain or loss on the disposal. They will not de-recognize the asset, right? And any amount we receive will be considered as a loan. Recognize the right of use asset, incorrect, because no control is transferred. The last requirement, which two of the following statements best reflect the requirement of IFRS 16 when assessing whether a contract contains a lease or not? Okay. A contract contains a lease only if the asset is specified in the contract. Yes. If the asset is specified, that contract contains a lease. If the asset is not specified, so no lease contract, right? I already explained it. A contract can never contain a lease if the supplier has a substitution right. Maybe if the substitution right is substantive. If the substitution right is substantive, so means that contract will not contain a lease. So it's a least preferable option. Let's check the other two options as well. A contract contains a lease only if the customer obtains substantially all the economic benefit from the use of the asset and direct its use. Yes, this option is good. So the correct option are option A and C. For this, the substitution right, it must be substantive. It must be substantive. The last one, a contract contains a lease only if the legal ownership of the asset transfer to the customer at the end of the contract. It's not compulsory. So the correct option are option A and C. So this was all about the MTQs Meridian Company.